Hello, everybody. At this time, we are talking about futures trading. Futures are contracts to buy or sell a specific underlying asset at a future date. The underlying asset can be a commodity, a security, or another financial instrument. Futures trading requires the buyer to purchase or the seller to sell the underlying asset at the set price, regardless of the market price at the expiration date. Futures trading commonly refers to futures whose underlying assets are securities in the stock market. These contracts are based on the future value of an individual company's shares or a stock market index. Futures trading on exchanges can include underlying assets like physical commodities, bonds, or weather events. And then we move to typical users of the futures markets. The first, most participants in the futures markets are commercial or institutional commodities producers or consumers. Second, most participants are hedgers who trade futures to maximize the value of their assets and to reduce the risk of financial losses from price changes. And third, other participants are speculators who attempt to profit from price changes in futures contracts. And then we move to getting started with futures trading. Starting futures trading requires some preparation and understanding of how futures markets operate. There are a step-by-step guide to help you begin. The first, educate yourself. Learn about futures markets, different types of futures contracts, and key terms like contract size, margin requirements, and settlement methods. Second, choose a futures broker. You'll need to open an account with a broker that offers access to futures exchanges. Check their commission rates, margin requirements, and trading platforms usability. Third, fund your account. Deposit the required margin funds. Remember that futures trading can be volatile, so start with an amount you can afford to lose. And then fourth, select your futures contract. Decide which futures contracts you want to trade, whether commodity futures like crude oil or financial futures like interest rate or stock index futures. And then fifth, place your trade. Decide your position, whether long or short, and enter the trade through your broker's trading platforms. And sixth, monitor and manage risk. Use stop-loss orders and maintain margin requirements. Futures trading can be risky, so having a solid risk management strategy is vital. And then advantages of futures trading. The first advantage, hedging. Futures trading provides a mechanism for hedging against price volatility. Participants can use futures contracts to offset potential losses in the underlying asset. Second, flexibility. Futures contracts have standardized terms and expiring dates, making them easily tradable. Additionally, the availability of different contracts and then maturities provides flexibility for participants to tailor their trading strategies according to their specific needs. Third, price discovery. Futures markets facilitate the process of price discovery by providing a platform for buyers and sellers to express their future price expectations. And then fourth, speculation. Futures markets provide opportunities for traders to profit from short-term price movements without the need for physical ownership of the underlying asset. And then fifth, leverage. Futures contracts typically require a smaller initial margin compared to the actual value of the underlying asset. This allows traders to control a larger position with a smaller investment, thereby magnifying potential returns. However, it is important to note that leverage also amplifies risk and traders should exercise caution. And then we move to risk of futures trading. The first risk, principal and profit are not guaranteed. Prices of futures transactions fluctuate due to changes in prices of the underlying asset and other factors. Principal and profit are not guaranteed. And second, you might not be able to trade at the price you expected. Futures prices are determined by supply and demand factors. There is a possibility that there will be fewer orders on the other side and you will not be able to trade at the price you expected. And then third, losses can be significant. Depending on market conditions, the margin initially deposited may not be sufficient and trading may not be able to continue unless additional margin is deposited in cash. Even if margin is added, further losses may be incurred and the margin may not be returned, or the losses may become even greater. And then fourth, you may have a deposit additional margin. If any irregularities in trading are found, measures such as margin increases and restrictions of substitute securities may be implemented. In such cases, it may be necessary to submit additional margin or replace substitute securities with cash. And then we move to types of futures trading. Futures trading spans various markets and industries, providing participants with diverse options, and there are the most common types of future trading. The first, commodity futures. These contracts involve physical goods such as agricultural products, energy commodities, and precious metals. Commodity futures are widely used by producers and manufacturers to stabilize costs and manage supply risks. For example, a coffee producer might sell futures to lock in prices for their next harvest. And then second, customized or OTC futures. Over-the-counter or OTC futures are non-standardized contracts tailored to the needs of the buyer and seller. These contracts are primarily used by large institutions for bespoke risk management. And then third, financial futures. Financial futures are based on financial instruments and include stock index futures, currency futures, and interest rate futures. These futures are popular among institutional investors and traders seeking to hedge or speculate on broader financial market trends. And then fourth, environmental futures. Environmental futures involve assets such as carbon credits, renewable energy certificates, and water rights. These contracts are increasingly important as businesses focus on sustainability and regulatory compliance. And finally, fifth, cryptocurrency futures. Cryptocurrency futures enable traders to speculate on the prices of digital currencies like Bitcoin without owning the assets. These contracts offer opportunities to profit from the volatility of crypto markets but come with significant risks. I think it is enough. Thanks for watching.